Guys, this is actually crazy. Today's video is basically about Cathie Woods talking about the housing market and a near recession. As you guys know, I am a firm believer in the housing market crash. Before we get into this video, make sure you like, comment, subscribe. We're on the road to 200 subscribers. Now, if my subscribers can raise like interest rates, it will make my day. As of right now, everything is unaffordable. The average sales price of a home has risen to $428,000. And believe it or not, a lot of people are actually playing over asking price, up to 100K sometimes. And there's a lot of people saying this is the best time to buy. Honestly, I don't think this is the best time to buy. Of course, the people who's trying to sell you a home will tell you this as the best time to buy. And also the mainstream media is trying to tell you like this is the best time to buy. But honestly, I think it's the worst time to buy. Mortgage interest rates are rising because I know somebody's in the comments going to tell me about that. But mortgage interest rates are now 6% and the Fed keeps raising basis points. But let's get into the video and let's see what Cathie has to say.
Now, the other thing that I wanted to focus on are two sectors that have been very strong, but are starting to fray at the edges, and we need them to stay out. In order to stay out of recession, we probably need these two sectors, housing and capital spending, to continue at a fairly strong pace. We're seeing some fraying at the edges. While housing starts were up a big 6.8% in February, permits were down 1.9%. Existing home sales were down 7.2%. New home sales were down 2% after an 8.4% drop the previous month. Pending home sales are down both month to month and year over year. And mortgage applications have been dropping for 2 months. So while housing prices are still up nearly 20%, according to the Case-Shiller indexes, on a year-over-year basis, and there probably still is a shortage, maybe the prices are taking people out of the market. On the capital goods side, we got a number, non-defense capital goods, which slipped.
Now, she mentioned something about home sales. Well, people are driven towards incentives. So when they see these home prices that are expensive like this, it's going to keep a lot of people out of the market. More and more people are going to look to rent. I live in Houston, and Houston is 52% renters and 48% homeowners, and the home ownership rate is going down. People are looking at renting as a better viable option as of right now, because buying a house is the biggest decision you can make. Nobody wants to buy a house under this stress. This is too much stress for people to go through. And also, not to mention, the housing market is very toxic as of right now. And don't even let me get started on inflation. The inflation rate is 8.5%. So people are making 8.5% less than what they were making last year. So that means even less of affordability. If homes keeps appreciating to these values and income growth is not keeping up, of course people are not going to be able to look at these houses. She's about to talk about something very important. And after she's finished, I'm going to explain the significance of what she just said.
So that could be a little bit of what's going on. Today, very importantly, with the employment report, the yield curve, 2s to 10s, as I started talking about earlier, inverted. And again, that's a warning to the Fed at 2.35% on the 10-year Treasury bond, which tends to track nominal GDP growth over time. So 2.3, 2.4%, that is telling the Fed, the bond market actually is telling the Fed, look, we think growth and inflation are going to be lower than expected, so be careful. We've been amused over the last, I would say it's maybe 2 months, that once the 2s to 10s started to invert, there was a shift by people who just wanted to be bullish on activity and growth and value stocks, a shift to the 3-month versus 10-year. Well, we've studied that, and the 2s to 10s, so that yield curve, is a leading indicator for the 3-month to 10-year Treasury yield curve. So
When the 2 and 10-year curve, it is typically a sign of recession. When the curve inverts, there has been a better than 2/3 chance of a recession at some point in the next year and a greater than 98% chance of recession at some point in the next 2 years. Now guys, the only reason why we are in this predicament is because of low inventory. But once houses hit the market and, real estate investors own 20 million homes, which is 20 to 25% of American homes. So once a lot of houses hit the market and people have more options to choose from, then they might have a huge fire sale of homes that people can get. This is why I tell people to rent until that happens, because as of right now, like I said plenty of times, this is the worst time to buy. And also, as of right now, guys, America is building more than it ever has been in a long time. Building permits are up in a lot of states. So